Welcome to Forex School Uganda. I'm Godfrey, and if you're here for the very first time, kindly subscribe, like and share the video as I bring you more educational content on the channel. Today we are going to be breaking down the USD Canadian dollar pair to see where price is and what we could do to prepare ourselves for the early shifts and turns in the market that we can take advantage of in the coming week. We are going to be doing a top-down analysis, breaking down market structure and marking out areas where we expect the early shifts and turns to happen, where we'll be on the lookout within the lower time frames for the setups that meet our entry criteria to form that we can then take advantage of for the easy early trades before the crowd comes into the market. Come with me to the charts. This is the USD Canadian dollar. We are on the monthly time frame and we see price has been bouncing off this area to the upside. Now, when you look closely, every time price would come to this area, it will be bounced off. Came again, was bounced off. Came again. The third time, it was bounced off again. And right now, it seems to be locked up within this range of this upper and lower resistance and support areas. But when you look, price didn't quite reach this resistance area. Now we know resistance is not necessarily a particular point, but rather an area, or let's call it a zone. So price didn't necessarily have to reach this area for us to say it reached the resistance point or the resistance zone. However, fact still remains, it has not touched it yet. And when you look at what is happening, you see that during this leg to the upside, there was a bit of a breather here, a hesitation, where price reached this area, retraced a little bit to create this bearish candle before an impulsive move to the upside. And so this hesitation in the middle of the range created an area of resistance that price broke above of. And now when resistance is broken, it becomes support. That's precisely what we see that happened, that after price breaking above it to the upside, price retraced and retested it, and we see it is kind of rejecting it now. This is a monthly time frame. The chart, the candle hasn't closed yet, but we analyze what we see. You always need to go by what you see, not what you think or imagine when it comes to technical analysis. And what we see is that this candle, monthly candle, is testing and rejecting at the moment this area of resistance turned support within the middle of the range. And if we bring our Fibonacci tool to measure the amount of the move to the upside as well as the retracement, the current retracement, we see that price touched this support area, which was a confluence of factors that included the support area as well as the 61.8 golden Fibonacci ratio, which is an added confluence for us to believe more that the buyers should be bullish after touching this confluence of the support area coupled with the 61.8 Fibonacci retracement levels, which should sufficiently act as a rejection point for price to reject price to the upside. Now dropping to the weekly. Now in this weekly time frame, what we see is that price was making a series of lower lows and lower highs while it moved impulsively to the downside. And after this last impulsive move to the downside, we've seen price move kind of correctively to the upside. And by correctively, I mean it wasn't moving so strongly. We see it form these kind of now higher highs and higher lows. It's a higher high, a higher low. And finally, after breaking above the last resistance area before this impulsive move to the downside, at this point here, with this bullish close above the area, we saw price move impulsively, now no longer in a corrective manner, but rather impulsively to the upside. And what we're experiencing now is what we know as a corrective move to the downside in the form of a retracement. Now, after an impulsive move and a correction, what do we expect to see in the market? Definitely, we expect to see another impulsive move to the upside to complete what we know as the impulse correction, impulse formation in the market. However, during this correction to the downside, the way it was moving, it created in between here, in the middle of the impulsive range to the upside, it created an area of support, which it was able to break below. However, once support is broken, it becomes resistance. And that's what this area has now become. It's essentially an area of minor resistance. And we can see it was able to hold price to the downside below it, leaving a long rejection wick to the upside, notwithstanding the fact that the candle closed bullish. However, the way it closed, it doesn't necessarily feel like a rejection wick, but rather a wick that we could see filled within the coming week. Now, again, we are not trying to predict the market. We can only go by what we see, and until we see it happen, we can only just analyze and not necessarily go by what we think. Intuition is important, born of experience. However, with technicals, you trade what you see. Let the market tell you what the market wants to do. And in that sense, what we would need to see is a break above this support area, now turned resistance, and potentially a retest of it, probably in the lower time frames, and we need to see this support area hold. Once it has been broken above as resistance and price comes to retest it now as resistance and support, we want to see it hold price to the upside, and price should bounce off to the upside to confirm to us that yes, the bearish momentum was done, and now the shift has come in for price to continue to the upside to complete the impulse correction, impulse move in the market. So dropping further down to the daily. So this is the daily time frame. And what do we see within this time frame? What we see, now remember, we've seen that the monthly is bullish, the weekly is bullish. So now we are down to the daily. We are trying to find confluences within the different time frames, of course trusting the higher time frames, and that's why we do the top-down analysis, and we look for all these time frames to be in sync for us to be able to take informed decisions when it comes to the placement of trades. And when you look at the current chart, we see price formed an area of support here. And this is a very strong area of support. The fact that price came to it, it was rejected to the upside. It came again to it, was rejected again, before it was finally able to break through to the downside. However, price was later to move to the upside, which makes this entire move to the downside a fake break to the downside. So we see price broke impulsively to the upside and retraced to retest this area of support that has rejected price severally, strongly. So it returned to retest it after the break above it. And when we bring our Fibonacci tool to measure the amount of the move to the upside as well as the retracement to retest the area of support, what we see is that price is rejecting this area, which is in confluence with the 61.8 golden Fibonacci retracement level, which makes it a very strong rejection area. And so in the coming week, we could see price bounce off it to the upside. And you see this was a very strong impulsive move to the upside, followed by a correction. And after an impulse and a correction in the market, what do we expect to come next? We expect another impulsive move to the upside to complete the impulse, correction, impulse formation in the market. Besides, you can see that price had moved impulsively to the downside, and after it formed some kind of a level with this bearish close after the bullish candle in between here, pushing price to the downside, and now with this leg to the upside, it left behind a formation of a W pattern, and this correction was necessary to complete the W pattern in the market by retesting its neckline. Now, since the neckline is fully retested, the W pattern is complete, and we expect move to the upside. Now, all this is just analyzing, trying to put the confluences together to inform our buyers. It is not predicting the markets. After we've done all our analysis, we are not going to just randomly gamble the markets by just placing buy trades. No. We drop to the lower time frames and wait for our confluences to match up from the higher time frames down to the lower time frames. Then we will be preparing ourselves for the setups and formations that we need to see in the market form. And then from those formations, we can then execute after our bias has been confirmed within the lower time frames. Because remember, the higher time frames are for direction, while the lower time frames are for our execution. And that's very important because we seek to time these early shifts and turns within the market way ahead of the crowd. And that's why it is important to do a top-down analysis so you can have an eagle's view of the entire market. Also, when you look closely, you will notice that with this move to the downside, it left what is likely to end up as an inverted head and shoulder, which is also a bullish pattern, further adding to the list of our confluences and solidifying our bias as bullish. However, the right shoulder is not yet completed. It would only be completed with a bounce off the current support area, and that has not yet happened. And that's why we usually drop to the lower time frames to time those early bounces long before they are visible on the higher time frames, and so we are able to catch such moves long before the market crowd comes in. Now, dropping down to the 4-hour, what we are seeing in the 4-hour is quite the opposite of what we've seen in the higher time frames, in the sense that price was forming higher highs and higher lows, higher highs and higher lows, while it was trending to the upside. But with this latest impulsive move to the downside, we've seen it distort market structure, breaking below this support area and this support area as well. And we see the structure of the market has changed from higher highs and higher lows to currently a new low being formed in the market, a lower low in that sense, as opposed to the previous higher lows that were being formed before the current impulsive move to the downside broke all the structure to the downside. With this distortion of market structure in the 4-hour, which is a median time frame, it is not a higher time frame, neither is it a lower time frame. It's just a median time frame, acting as a bridge between the higher time frames and the lower time frames. And so it is very important to take note of what is happening within this very time frame to inform your trading decisions. And what we see here is that price had formed this area of resistance. Price retraced, then broke above it impulsively. Now, while price was trying to drop down to retest it, it took this huge volume to break below it. Now, that means it's a very strong area of resistance. That's why for price to be able to break below it upon retest, it took this huge volume to be able to break and close below it to violate the previous market structure. And so, given its strength, we could see price retrace to it and bounce off to the downside, in which case it would lead to a formation of a typical head and shoulder pattern in the market, which would be a bearish pattern in this sense, in this case, as opposed to what we have seen in the higher time frames. Now, remember, the higher time frames hold much ground than the lower time frames. And so, our bias from the higher time frames is bullish until we start seeing areas of support violated in the higher time frames and higher highs and higher lows turning into lower highs and lower lows. Now, the fact that that hasn't happened yet in the higher time frames, what do we do then? Well, the fact that we are price action traders, we only have to wait to see how the market acts, and then we react to the actions of price. That's what makes us price action traders. We do not try to preempt the market or try to predict the next moves in the market. No. We only react to the moves that the market is forming, because as technical traders, our trades are informed by the market moves. And so now, what we need to see in the market is price now turn back to the creation of the structure that saw price rise to the upside. And what kind of structure is that? It's a structure. It is the formation of higher highs and higher lows. And so we would need a creation of a high, then a move from it to create a low, then a break above the high that was formed previously, and I mean this high here, and then probably a retracement to this high, which would in this case act as a support area, and we would need to see support hold to confirm to us that the bias has now turned bullish before we can start executing. And so we would need to see the structure change, price form resistance, then price break above that resistance, retrace to retest it as support, then be able to close above it to confirm to us that the breaks are not fake but they are real, and to confirm to us the shift in momentum from now the bearish momentum we see to the bullish momentum before we can start thinking of taking bullish trades in the market. So looking at the COT report, which is the Commitment of Traders report, this is a report that big institutions are required by law to submit to the CTFT every Tuesday, but the data is released every Friday. And this shows what the big players are doing in the market. It exposes their positions within the market. Now, the data we are seeing here is for the Canadian dollar. But remember, on the spot market, currencies are traded against the dollar, or these positions are rated against the dollar. Remember, this is data that is released in the US, so it is all about the US dollar, but regarding other currencies or other financial instruments. But it is the positions that are being held against the dollar. Now, what we see is this. When you look at the position of longs, the previous 3 filings, we had the longs at 32,000. The immediate previous filing was 34,000, meaning that the longs are increasing. And now the current filing, it's 35,000. And when you look at the net figures in terms of increase, the last 2 filings, we saw 1,341 long positions added in the market, as in long positions on the Canadian dollar. Now, the most recent filing, which is this last Tuesday, it was 1,113 long positions taken in the market within the week. Now, compare that. Now, these are long positions being taken, as in long positions on the Canadian dollar being taken, not on the USD, but on the Canadian dollar. Now, that means, remember, one course of action on one currency is the reverse course of action on the other. So if they are buying the Canadian dollar, that means that inversely they are selling the US dollar, because the Canadian dollar is being traded against the US dollar. So they are buying with the most recent filing, they had 1,113 positions, long positions on the Canadian dollar. Now, compare that to, let's first look at the positions themselves before we come to the net figures. We've looked at the long positions from 32,000 to 34,000 and now 35,000. Now compare that to the short position, 102,000, 102,000, and now 126,000 short positions placed in the market. So, much as they are buying the Canadian dollar, the ratio at which they are buying it compared to the ratio at which they are actually selling it is incomparable. So now, when you look at the short positions, they are way bigger. Now just imagine the buy positions are only 35,000, but the sell positions are 126,000 positions. That means they are selling the Canadian dollar at a huge scale compared to the rate at which they are buying it. I mean, just look at these 2 numbers, 35,000 buy positions and 126 short positions. Now, when they are shorting the Canadian dollar, what are they doing to the US dollar? Because every instrument is traded against the US dollar on the spot market. So if they are selling the Canadian dollar, what are they doing with the US dollar? Definitely, they are buying the US dollar while they are selling the Canadian dollar. So they are selling it heavily, which means inversely, they are equally heavily buying the US dollar. And so when you look at the net positions, you can see that the net positions are negative 90,000. Negative 90,000. That means they've been closing off the longs heavily. They are so much closing the longs on the Canadian dollar and instead shorting it. And so this spells a weakness of the Canadian dollar against the US dollar, since every instrument on the spot market is rated against the US dollar. Now, remember, when it comes to the USD-CAD pair or the US dollar Canadian dollar pair, the Canadian dollar in this case is the quote currency, while the US dollar is the base currency. So if they are shorting the Canadian dollar, that means they are buying the US dollar inversely. And so that means that we expect the price of the dollar to rise against the price of the Canadian dollar. And so when it comes to the market, to the technicals of the market, we expect the US dollar to be rising against the Canadian dollar. Why? Because the US dollar, remember, within this currency pair is the base currency. And so if they are shorting the alternate, or if they are shorting the alternate currency or the quote currency, they are inversely buying or longing the base currency, which in this case is the US dollar. And so if they are longing the US dollar within this currency pair, that means we would expect rising prices within this pair. And that equates to bullish moves in the USD-CAD pair. That doesn't mean we are just going to recklessly be longing this market. Like I said, we need to see the market structure change from the bearish one that we are seeing on the 4-hour to a bullish market structure before we can think of timing our positions in the lower time frames to buy once the setups are formed within the market that meet our entry criteria. Thanks for watching. Be on the lookout for more educational content dropping on the channel. But just to be sure you do not miss out, click the bell icon so you are alerted every time I post new content on the channel. Also, remember to subscribe. Don't you forget to subscribe to the channel. I'll see you again.